This video will illustrate how to construct the financing activity section of a statement of cash flows using the indirect method. The information you have available to you is the income statement listed here, the balance sheet listed here, and additional information given to you right down here. So let's go to the answer key that I've started to create, the statement of cash flows. Again, we're ignoring the operating activities. We're not asked to produce that here. We ended our last video with the investing activities, and now I'm looking into moving on to the financing activities. And just a reminder, a financing activity is any sort of a cash flow where I went out and financed my business. So financing can be taking out a loan, selling stock, paying back loans, paying dividends, paying back stock. So if I'm looking at all this data I've been given here, I got to sift through what do I need to use. And so financing activities are going to be long-term liabilities and stockholder equity accounts. And we include this dividend payable because that is a financing activity. Now when I'm doing and creating a statement of cash flows for the investing and the financing activities section, I want to always start with cash inflows, so cash received. So, and I'm not quite sure yet which ones I received cash, so I'm just going to start going down the line on these items and try to determine how much cash flowed from the changes in each of these accounts. So let's start with dividends payable because that's listed first. And when I pay a dividend to my shareholders, that's a return of their profit that they've earned, so we consider that a financing activity. We started the year with $10,000. I'm going to go back to the little t accounts that I've created here. $10,000 is what we start with, and if we look at the balance sheet, we know we end with $14,000. So if a promise, this is a promise goes up, that means I promised to do something and I didn't pay them, right? So you might want to, your gut might tell you, well I got to subtract something maybe. But let's go back, and we need a little bit more information to determine how much cash flowed here. And in the additional information, I'm told in number 5 here that cash dividends declared throughout the year were $74,670. So somehow this factors into the change here, because it's dividends declared, if you recall from our earlier chapters, is the dividend declared is a dividend payable. So what happens when I declare $74,670 is I'm increasing how much I'm promising to pay at some future date. Now, with simple math here will tell us that if I start a promise at $10,000, I add more of a promise, and I end with a smaller promise, I must have paid something out to get rid of that promise. So if I start with $10,000, I add more promise to pay, and then I subtract what my ending promise is. That tells me I've paid out $70,670 in dividends to my owners, so that's the cash outflow right there. That's a cash outflow. I want to start with my cash inflows in the financing activity section. So we'll just put that number on hold. We'll come back to it in a second. Let's move to the mortgage payable. A mortgage payable is a loan, long-term loan, a house, mortgage house typically you think of. And if I start the year with no loans and I end the year with a loan, that probably means I went to the bank and borrowed some money. So let's just confirm that or deny that depending on the information that we're given down here. So number 2 says a mortgage note was issued for $40,000. So we're to assume that that means we received cash of $40,000. So we started the year with 0 debt. We ended the year here with $40,000. The only way, and we were told that the only thing that happened was an increase. So that's an inflow. If I go to the bank, they give me cash, I'm taking cash in, that's an inflow. So I'm going to say right here that I have cash, oops, if I could spell, cash received from issuing mortgage note payable. So I have a cash inflow of $40,000. Let's see if we have any other cash inflows. So we've dealt with a cash outflow for dividends, cash inflow for mortgage. Look at what happened to my bonds payable. My bonds payable, which is also a long-term liability, a promise to repay at a future date, started with $250,000 and it ended at $150,000, so it went down. Looks like it would be some sort of a decrease, and we decrease a loan or bond payable by paying in cash typically. But look what we're told in number 4 here. 2,500 shares of common stock were issued in exchange for the bonds payable. That means that we didn't pay any cash. Our bondholders took 2,500 shares of common stock, and that's why our common stock went up. And in exchange, they said, you no longer owe us $100,000. That's what this is telling us right here. That's a non-cash transaction, so there's no cash flow here. And we're going to assume there's no cash flow here. We can ignore retained earnings. That's a culmination of net income and the dividends that we've paid. So common stock is a non-cash transaction. Bond payable is a non-cash transaction. Dividends and mortgage payable are the only two financing activities that we've got to deal with on the statement of cash flows. And since we started with the cash inflow, we end with the cash outflow. So we're going to say less cash paid for dividends. And remember, I said that the dividends were right here. We figured that out before, and so I don't need to have that bold. And so we're going to say now those are the other. We said this is non-cash. The change was non-cash, right? Just so we know, and this we don't have to deal with retained earnings. So the statement of cash flows for financing activity ends like this. It says net cash flow. This will be used by financing activities. The reasons it's used is because there's the outflows are larger than the inflows, and so that is the end of the financing activity section for the statement of cash flows.